Grab, regarded as the Uber of Southeast Asia, has been one of the most successful tech companies in the Southeast Asian region, attracting major investors including Tiger Global, SoftBank, and even Microsoft. Today, it is one of the largest startups in Southeast Asia, but despite its incredible growth story, Grab stock has been under a lot of pressure ever since it went public in 2021, down more than 80% from its all-time highs. About 2 years ago, I remembered Grab announced that the company was going public via a SPAC merger, and at that time, it was a big deal because people have been talking about Grab for years, and then all of a sudden, it is going public. But what turned me off was the fact that Grab was going public at a $40 billion valuation, and not only that, the company was still unprofitable. So I thought this doesn't feel right and this was way too overpriced, and luckily I walked away and didn't even consider buying the stock. However, Grab just reported Q4 earnings, and what caught my attention was that the company turned profitable for the first time ever. I looked back on the stock price, and oddly enough, the stock was still down 80% from its all-time highs, and that's when I thought, you know what, there must be some value right here. So in this two-part video, I will share with you my research on Grab stock. In part 1, I will briefly talk about what the company does, its competitive moats, as well as its growth profile. And then in part 2, I will be talking about the company's profitability, financial health, outlook, valuation, and risks. Also, if you like to read the article version of this analysis, you can find the link to my article in the description box below. And with that out of the way, let's talk about what Grab does as a company. So Grab was founded back in 2012 in Malaysia by two Harvard students, Anthony Tan and Tan Hui Ling. In a nutshell, Grab is the leading super app in Southeast Asia, connecting millions of consumers, merchants, and drivers across 500 plus cities in 8 countries. The company was initially launched under the name My Taxi, which offers taxi hailing services through a mobile app. Since then, the company has expanded to other forms of services, which is why the company rebranded to Grab to reflect its multitude of offerings. Basically, the company offers mobility services similar to Uber. For example, you can order private cars through GrabCar, taxis through Grab Taxi, and motorcycles through Grab Bike. In 2015, Grab got into the deliveries business through the launch of its package delivery service, Grab Express, and a few years later, Grab expanded to food and grocery deliveries as well. In 2017, Grab also launched its mobile wallet offering called Grab Pay. Since then, Grab has added new financial services including lending, buy now pay later, insurance, digital banking, and more. In addition, Grab also provides value-added services such as advertising through Grab Ads, as well as mapping and location-based services through Grab Maps. Ultimately, with all these services, Grab aims to drive Southeast Asia forward by creating economic empowerment for everyone. With that being said, I think Grab might just be the only company in Southeast Asia that has a chance of achieving and sustaining super app status for years to come. Why? It's because I believe that Grab has one of the strongest competitive advantages I've ever seen in a company. According to Morningstar, there are 5 sources of sustainable competitive advantages, namely intangible assets, switching costs, network effect, cost advantage, and efficient scale. According to my research, I believe Grab has all 5 moats, which is quite rare for any company. So let's go through each of the moats and discuss why Grab has them. The first one is intangible assets, and according to Morningstar, intangible assets are things such as patents, government licenses, and brand identity that keep a company ahead and competitors at bay. Without a doubt, Grab has an intangible asset moat in the form of a strong brand identity. After all, the company is the first mover in ride-hailing in Southeast Asia, which helps the company amass a large following early on. And not only that, its super app also has tons of great reviews with a 4.8 star rating in the Android store and a 4.9 star rating in the iOS store. Grab is also a household name, and just like Uber, it is also a verb. Only the best-of-breed companies such as Uber and Google turn into verbs, and Grab is fortunate and popular enough to belong in this highly reputable group. And another reason why Grab has a strong brand identity is that everywhere you go in Southeast Asia, you see Grab. You see the app in people's phones, you see green jackets all over the street, you see merchants accepting Grab Pay as a payment option. It's just everywhere. It's quite impossible to quote unquote avoid the company because wherever you are or wherever you go in Southeast Asia, you're pretty much exposed to the Grab brand. And I can confidently say this because I'm a user myself and I live in Indonesia. So with that being said, I think Grab has a really strong brand moat in Southeast Asia. The next mode in Morningstar's definition is switching costs, which are obstacles that keep customers from changing between products, like from one company's product to a competitor's product. So Grab basically strives to be the everyday everything app that deeply integrated into consumers' lives. The company focuses on everyday transactions such as transportation, food delivery, and payment, and many more. So you have all these features and services at your fingertips. You get the most complete catalog of transportation types, merchant providers, and food items. You get top-notch service quality, including speed, ease of use, and customer service. Basically, you have everything you need in a single app. Now, the question is, why would anyone use a different app that offers fewer services or lower quality? Price may be one reason, but other than that, I don't see any other reason why they would switch out to another platform. Having a single app that covers everything you need is super convenient, and that is why the Grab ecosystem is very sticky. Moreover, as Grab introduces more products and services, the more offerings consumers use, and the more offerings consumers use, the more loyal they become. As you can see, 1-year retention rates increase significantly when consumers use more and more offerings. If they use one offering, retention rate was only 37%. If they use more than 3 offerings, retention rates increase to as high as 88%. For instance, Grab launched Grab Unlimited back in 2022, which is a subscription service that offers unlimited savings on deliveries, rides, and more. And as of Q3, Grab Unlimited subscribers account for 1/3 of deliveries GMV and spend 4.2 times more on food deliveries than non-subscribers. So not only do subscribers stay longer on the platform, they spend more as well, which is great for Grab. And we can see similar behaviors in the fintech side of the business. For example, people who use GrabPay, which is a mobile wallet offering, spends 4 times more and have 1.5 times higher retention rates than cash users. In addition, driver partners who take on a loan with Grab also recorded 1.5 times higher retention rates compared to drivers without a loan. So being the everyday app that it is today and being the innovative company that keeps on launching new products and services, I believe Grab has high switching cost modes that not only prevent users from switching to other providers, but also drive higher spending within the Grab ecosystem. Moving on, the next competitive mode is network effects, which according to Morningstar occurs when the value of a good or service increases for both new and existing users as more people use it. In Grab's case, the more users join the platform, the more valuable the platform becomes. And not surprisingly, the Grab ecosystem is large and growing with 37.7 million monthly transacting users, 4 million merchant partners, and 5 million plus driver partners, processing more than 10 million transactions daily. And do note that this slide was made back in 2022, so the numbers would likely be higher today. At the same time, Grab's enormous network also makes cross-selling incredibly efficient. For example, following the launch of GX Bank in Malaysia in November 2023, Grab was able to attract more than 100,000 depositors within 2 weeks of launch, with Grab users accounting for 79% of depositors in December 2023. That is an incredibly high cross-selling rate, and the crazy thing is, Grab can practically do this with every single new product it launches, which will drive incremental revenue growth at relatively low cost. More importantly, as Grab adds more offerings, more consumers should join the platform, and this should increase overall spending, which will lead to more income and earnings opportunities for merchants and drivers. Consequently, more drivers and merchants will also join the platform, which ultimately leads to even more consumers, and the cycle goes on and on. This is the Grab ecosystem flywheel in motion, which creates powerful network effect modes for the business. Next, I believe Grab has a cost advantage mode as well. According to Morningstar, a company with a cost advantage can produce goods or services at a lower cost, allowing it to undercut its competitors or achieve higher profitability. So, to find out if Grab has a cost advantage mode over peers, we can look at Gojek's full year and Q4 earnings results. And if you're unaware, Gojek is Indonesia's largest on demand services company and is probably Grab's largest direct competitor. As you can see, Gojek has an adjusted EBITDA margin of negative 0.4% in 2023 as compared to Grab's on demand adjusted EBITDA margin of 6.3%. In Q4, Gojek's adjusted EBITDA margin was positive 1.7%, and while that is better than its full year results, its adjusted EBITDA margin is still much lower than Grab's on demand adjusted EBITDA margin of 6.7% in Q4. In other words, Grab has a huge cost advantage over Gojek, and I'm not going to even talk about the smaller competitors because they most probably have much worse unit economics than Grab and Gojek. Why? Because Southeast Asia is a highly competitive market. It's a battlefield here, and the only way to achieve profitability is to have a large enough scale to gain the necessary operating leverage. Grab is the largest super app by a wide margin, and that's why it has a huge cost advantage over peers. So the fifth and final mode according to Morningstar is efficient scale, which benefits companies operating in a market that only supports one or a few competitors, limiting rivalry. So much like how the US ride-hailing and food delivery industries are dominated by a few players like Uber and DoorDash, the Southeast Asian market is also a winner takes most market. So as it stands, Grab is the largest player in mobility, deliveries, and financial services in Southeast Asia. According to management, Grab is the largest on-demand platform in the region at a scale that is over 3 times larger than its next closest competitor. And to provide you with some context, we can look at the food delivery market in Southeast Asia. As you can see, Grab has such a dominant market position in 5 of Southeast Asia's largest countries. As you can see, Grab has a 63% market share in Singapore, 50% market share in Indonesia, 65% in Malaysia, 47% in Vietnam, and 61% in the Philippines. And this is just the food delivery market. If we look at the ride-sharing market, Grab has a duopoly with Gojek in countries like Indonesia and probably a monopoly in other countries. And as far as I know, Grab is also the most funded player in Southeast Asia, which enables Grab to take market share and expand more aggressively than competitors. And this is one major reason why Uber failed in Southeast Asia, ultimately selling its Southeast Asian operations to Grab. So according to INSEAD, with $4 billion in new funding, Grab overtook Uber as the leader in Southeast Asia, where Uber spent just $700 million. And when Uber realized that they have underinvested, it was already too late for them. With that being said, I think Grab has efficient scale modes that gives the company a monopolistic position in Southeast Asia. And combined with its 4 other modes, I believe Grab has one of the most durable businesses in modern times, capable of crushing competition and delivering strong earnings growth for shareholders for years to come. Before we dive into the financials, I want to quickly talk about Grab's business model and how the company generates and recognizes revenue. So at a high level, Grab operates 4 business segments, namely deliveries, mobility, financial services, and enterprise. And here you can see what a typical food delivery transaction looks like. And as you can see, there's a few players involved, including consumers, drivers, and merchants, with Grab acting as the middleman between them. In essence, Grab generates revenue by charging a commission rate based on the total value of the order, or GMV. So Grab earns commissions from drivers and merchants, and at the same time, Grab also pays out incentives to consumers, drivers, and merchants in the form of discounts or rewards, which is netted out of commissions, which leads to revenue. So that's how Grab recognizes revenue: GMV times commission rate minus incentives, which gives us revenue. And that's just for the delivery segment. The company also generates mobility revenue in a similar fashion, just that merchants are not involved in the transaction. In addition, Grab also generates financial services revenue through transaction fees and through services such as lending and insurance. And last but not least, Grab generates enterprise revenue mainly through advertising services. With that out of the way, let's now look at the financials of the company. In 2023, gross merchandise volume or GMV was $20.1 billion, dollars, up 5% year over year. And in Q4, GMV was $5.4 billion, dollars, up 9% year over year. As you can see, growth has slowed down quite a bit compared to 2021 and 2022 levels, but the company is seeing some acceleration in growth over the last few quarters, which is a good sign that the company is gaining momentum and market share. That said, growth was primarily due to the growth of its on-demand segments, namely mobility and deliveries. Gross merchandise volume growth was also driven by the increasing number of monthly transacting users or MTUs, which was 37.7 million in Q4, up 12% year over year. In 2023, the average was 35.5 million MTUs, which is up 8% year over year. And to give you a little perspective on how large or how small that is, there are about 680 million people in Southeast Asia, which means that Grab has about 5.5% market penetration rate in the region. Whatever it is, I'll be keeping an eye on user growth as it is one of the most important metrics to track since users are a leading indicator of future revenue growth. That said, as a result of GMV and user growth, Grab generated $2.4 billion of revenue in 2023, up 65% year over year and beating management's midpoint guidance of $2.25 billion issued back in Q1 last year. In Q4, revenue was $653 million, up 30% year over year, and this beat analyst estimates by $20 million. So it's great to see the company outperform expectations. So growth was mainly due to GMV growth across all segments and a change in business model for certain delivery offerings. And if you haven't realized, revenue grew much faster than GMV, and this is due to the reduction in incentives paid out. So as a reminder, Grab's revenue is equal to GMV times commission rate minus incentives. So if Grab pays out less incentives, revenue naturally increases as well. And that is what we saw in 2023, where Grab paid out $1.6 billion of incentives, down 19% year over year, which is 7.6% of GMV. In Q4, incentives paid was $397 million, down 4% year over year, which is 7.3% of GMV. As you can see, Grab's total incentives as a percentage of GMV has been decreasing over the last few quarters from as high as 13% to just 7.3% as of Q4. And if you're wondering, Grab was paying loads of incentives back in 2021 due to competitive pressure as well as to minimize user churn during the pandemic. However, market conditions improved, which allowed Grab to reduce incentives without putting significant pressure on the company's growth. Although incentives as a percentage of GMV picked up slightly quarter over quarter, the overall trend is still downwards, which means that Grab is depending less and less on incentives to fuel platform growth, which is great to see. Looking at revenue by segment, we can see that all segments are growing strongly, driven by increased monetization and reduced incentives. In Q4, deliveries revenue was $321 million, up 20% year over year. Mobility revenue was $237 million, up 26% year over year. Financial services segment was $56 million, up 102% year over year. And enterprise revenue was $39 million, up 124% year over year. So I just want to point out that the financial services and enterprise segments grew triple digits year over year, and although they are still small compared to the on-demand segments, I believe they could be a major revenue drivers in the coming years as Grab continues to scale and monetize its user base. So let's take a look at each segment in more detail. For the delivery segment, Q4 revenue was $321 million, up 20% year over year, and this was driven by GMV of $2.6 billion, up 13% year over year, due to higher spend per user, higher deliveries MTUs, which reached an all-time high in Q4. Greater affordability also contributed to growth. For instance, Saver Deliveries, which is a delivery option that offers a lower delivery fee in exchange for a longer delivery time, increased average order frequency by 1.6 times as compared to non-Saver users. So this is yet another great example of high switching cost moats within the Grab platform. For the mobility segment, Q4 revenue was 237 million, up 26% year over year, driven by $1.5 billion of GMV, which grew 28% year over year. This was due to higher mobility MTUs, higher average order frequency, and the rebound in the travel industry. In addition, Grab grew its driver supply by 11% year over year, which helped to facilitate more orders. Turning to the financial services segment, revenue was $56 million, up 102% year over year. Total payment volume or TPV was $4 billion, up 6% year over year. And do note that Grab is focusing more on driving on-platform transactions as the unit economics for off-platform transactions were not as attractive, and that is why TPV growth is not very strong. That said, revenue growth for the segment was driven by improved monetization as well as increased adoption of its lending business, which grew 57% year over year in Q4 to $1.5 billion. Some other highlights in Q4 include Kakao Bank, which is South Korea's leading digital bank, investing a 10% stake in Superbank, which is Grab's digital bank in Indonesia. As discussed earlier, in November, Grab also launched GX Bank in Malaysia, the first digital bank ever in the country. So with all these developments in the digital bank side of Grab's business, I think we'll continue to see robust revenue growth in financial services revenue in the next few quarters. And finally, we have the enterprise segment, which consists mainly of advertising revenue. In Q4, enterprise revenue was $39 million, up 124% year over year, driven by GMV of 64 million, which grew 40% year over year. So the segment is quickly gaining traction with self-serve active advertisers increasing 54% year over year and average spend by active advertisers growing 129% year over year. And just like the financial services segment, I think the enterprise segment will continue to grow rapidly as the company continues to scale and monetizes its platform. Overall, Grab is showing robust revenue growth across all its segments, and considering its competitive moats, I don't see any reason why it will slow down. In addition, platform monetization and incentive optimization are improving, which should lead to robust revenue and earnings growth moving forward. With that being said, thank you guys so much for watching part 1 of my Grab stock analysis, and if you're interested in watching part 2, don't forget to subscribe to my channel and turn on the notification bell so you won't miss the video. Thanks again for watching part 1, and I'll see you guys in part 2.